Welcome to Yahoo Finance Live. It's Tuesday, January 3rd here in New York City. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on the first trading day of the new year. But when you take a look at the big board, once again, we are starting the new year with pretty much what we were talking about last year, those fears of high inflation and aggressive Fed weighing on the broader markets. You're looking at the Dow off just over 100 points right now. S&P also in the red, off just about 0.6%. The Nasdaq 100 off about 0.75%. So fears here just about an aggressive Fed, what that could mean in terms of the chances of a recession and what that means for the economy here in the new year. We're seeing that reflected when you take a look at the price of crude. You're looking at crude hitting the lowest level that we've seen in just about 2 weeks, settling just below $77 a barrel. Let's dive into some of the sector action that we are seeing this afternoon. We're still looking at gains from communication services, financials in the green, real estate barely in positive territory, but those losses that I was just talking about in crude reflected in the XLE, the energy sector, the biggest loser of the day of all the major sectors here, off just about 4%. Taking a look at some of those individual movers, this move to the downside, we're seeing that reflected in some of the large cap tech names. Apple, one of the biggest decliners there. Look at Tesla having its worst day or touching the lowest level we have seen for the stock since just about 2020. Let's take a look at some of the buying action though, because in China, we're taking a look at some of the US listed Chinese names as the board freezes a little bit there, but Alibaba up just about 4%. You're looking at JD.com up nearly 3%, and Baidu, one of the outperformers in the market today, Dave, up nearly 5%.
Thank you, Shauna. Happy New Year.
Happy New Year.
Good to see you again. All right, FTX founder Sam Bankman-Fried pleading not guilty to fraud charges. Bankman-Fried currently facing 8 criminal counts against him, including wire fraud and conspiracy to commit money laundering. Judge Lewis Kaplan has set Bankman-Fried's trial date for October 2nd, 2023. Mark your calendars, friends. We'll have more on this story in just a few minutes. But first, we're going to get over to Jared Blickery with getting us up to speed on the tech industry, my friend. Some movers today.
Yes, let me get the Wi-Fi Interactive up to speed here, and unfortunately it seems to be stuck. So let's do this by memory. Apple, first of all, facing a year of declines. Its all-time high was actually 1 year ago. It was the first trading day of 2022. It reached a peak market cap of $3 trillion. Guess what? Now it is $2 trillion. So it has joined Amazon in joining the $1 trillion club. That is losses, $1 trillion in market cap losses. Amazon also in that boat. Apple still the most valuable stock in the world, but you take a look at Tesla as well. Tesla facing another serious decline. No word on whether this has anything to do with selling by Elon Musk, but it probably has a lot more to do with that deliveries miss. So all in all, when you take the two biggest bellwether stocks in the world, Apple and Tesla both facing huge losses on day one of a new year. That is a significant signal because January, it's supposed to be, as January goes, so goes the year. So day one's supposed to be bullish. We'll see how the rest of the week and the rest of the month pans out. But so far, a little bit of cold water being poured on the new year here for investors.
Certainly is, Jared. All right, thanks so much. Let's talk about the drop that we're seeing in Tesla. A lot of that drop being driven by the fact that the company missed its Q4 delivery numbers. You're looking at losses of just over 12%. The drop of more than 13% earlier in this session put it on pace for its worst day that we have seen in more than 2 years. Let's talk about this, what it could mean for the company going forward. We want to bring in Garrett Nelson, CFRA Research Senior Equity Analyst, for more on this. And Garrett, let's just get your take on this, because certainly we're seeing some concern reflected in the stock move today. I guess, does this spell any trouble, do you think, for the company moving forward?
Yeah, thanks for having me. We really think this sell-off is quite overblown. And we view a lot of the concerns surrounding Tesla as priced in following the steep declines in the stock price that we've seen over the last few months. But I think if you take a step back, you know, they posted a record high sales for the quarter. Q4, just over 405,000 units. Wasn't quite as high as the consensus, and that's why the stock is being hit. But still, you know, it was up 31% year over year. That type of growth is above and beyond anyone else in the auto industry. And looking ahead to 2023, we do see some positives here. We think that they could potentially announce a stock buyback in the range of $5 to $10 billion. On January 1st, the lower price versions of the Model Y and the Model 3 suddenly became eligible for a $7,500 federal EV tax credit. And we know they're continuing to ramp up production at their new factories in Austin and Berlin. And then they have the Cybertruck, which should debut, by the end of this year. So we don't think it's all negative. And in fact, we think this sell-off really presents a good buying opportunity.
Garrett, since this Twitter takeover, it is clear where Elon Musk's passions lie. Just about minute by minute, sipping from a fire hose, him being distracted with the Twitter platform and with changes, with bans. How concerned are you about this distraction?
Clearly, it's been a huge overhang, on the stock ever since the acquisition was finalized. But we think he's really on a better path going forward. We thought we've been saying that he really needs to take a step back, and the sooner he finds a CEO to replace him at Twitter and assumes more of a chairman role there, the better. And we think he's currently doing that right now, and so we think that overhang will really be lifted here at some point in the coming weeks and months.
What gives you that confidence that he is in a better place now?
Yeah, well, he did of course, the poll on Twitter, and the majority of respondents said they thought he should resign as CEO. So we do think that he's currently in the process of moving in that direction. But certainly the sooner the better. It's been a huge distraction. There's been some damage to the brand, we think, in the process. But really, the best thing that he can do is be focused more on Tesla, on getting the Cybertruck to market as soon as possible. We know that forthcoming model has the highest backlog of any forthcoming EV in the market by a wide margin. And so, the sooner they bring that new vehicle model to market, the better.
Good. I know you certainly are pretty bullish when it comes to Tesla. It's your top industry pick, the top performing stock in the industry. You see it being in 2023. But aside from Twitter and the distraction there are, of course, some concerns about demand given the worsening macroeconomic backdrop that we are experiencing right now and likely to experience at least in the first half of next year. Do you see that as a big challenge, not only for Tesla, but of course for some of its competitors out there as well?
I think that's why the stock is being hit so hard today, because there have been these whispers, demand's kind of an issue. And, here it was, Tesla's third straight quarter in which their production has exceeded their deliveries. And so, it kind of makes sense, these announcements that they've had about, taking extended downtime at the Shanghai factory, to really bring supply and demand back in balance. But, Tesla's built a fair amount of inventory here over the last 6 to 9 months, and they really need to bring the supply and demand back into balance.
I'm curious, you mentioned the Cybertruck there, and a lot of headlines devoted to its pre-orders, somewhere between 1.5 million and some have it north of 3 million. Those require nothing but $100 fully refundable deposit, at least according to my research. What gives you confidence that those people are going to follow through, and what type of catalyst will the Cybertruck be for Tesla?
Yeah, we do think it'll be a catalyst, and we think when people actually see the vehicle on the road, it'll generate a whole lot more demand and more interest. Tesla's kind of at a point where they haven't had a new vehicle model aside from the recent Semi, which is in its own, commercial truck class. They haven't had a new vehicle model since the Model Y debuted in March of 2020. And so, the sooner they build that factory production line at the Austin factory and start producing the Cybertruck, the better.
So, Garrett, Tesla is just one of the names that you have on your radar. You were recently out with your big predictions, your top 10 predictions for 2023 when it comes to the auto industry. I already rattled off the first one that you predict Tesla will be the industry's top performing stock in 2023. But let's go to number 2, because you predict Ford shares are going to outperform those of rival GM in 2023. What is it that you think gives Ford the edge heading into the new year?
It's mainly Ford's strategy, and we have a lot of confidence in their CEO, Jim Farley, and the direction that he's taking with the company. Ford also recently increased their dividend by 50%. The stock's yielding has a dividend yield of about 5% at these levels, whereas GM has taken a really more aggressive strategy in growing their EVs, setting a date in the future in which they plan to be all electric. Now, the problem with this is that, we think the EV market, it's going to take time. It's several years for demand to really grow. And as of the most recent quarter, EVs accounted for well under 10% of all U.S. vehicle sales. And so we think Ford is taking the right approach, which is a more balanced approach in growing EVs, as well as not phasing out internal combustion engine vehicles too quickly. And Ford's done very well. They've quietly become the number 2 EV seller in the U.S., a distant second behind Tesla. But their new models, such as the F-150 Lightning, have generated a lot of buzz and are selling very well.
Big story to watch in this new year. Happy New Year, Garrett Nelson. Good to have you.
Thanks for having me.
All right, we're just getting started here on Yahoo Finance Live. Coming up, stocks not off to a great start in 23. Find out where they could be headed the rest of the year. And a lawyer tells us Sam Bankman-Fried's defense might be after the FTX founder pleads not guilty. And one analyst is giving Netflix a double upgrade. He'll tell us why he's so bullish on the streaming giant. Don't go away. All right, let's check into the markets on this first trading day of 2023. As you can see, stocks moving down across the board. The Dow dropping about 75 points. The S&P and Nasdaq, reminder, had their worst years since 2008 and starting 23 in the same direction. Off just a bit, albeit, but not the direction we would like to start this new year. Let's talk about it with Eddie Gabor, Key Advisors Group CEO and co-founder. Eddie, Happy New Year, sir. Is this the type of 23 that we expect?
It is. Look, based on my notes that I've been sending really since the beginning of last year, that we've been pretty bearish, the most bearish of my career. And we've been advising clients as we went into the December months and the debate on Santa Claus rally or not Santa Claus rally. And our message to clients is we felt like going into this year, the first half was going to be the last phase of the bear market. And that last phase, in my opinion, is always the most painful. And what generally happens, again, in our opinion, is you start to see the larger cap names really sell off because everything else is sold off and there's nothing left to sell other than those companies that are so widely held. And you saw that really start to materialize in December. Again, it's happening today. And the biggest reason really is the macroeconomic environment. I mean, we are decelerating from a growth perspective. And I think the biggest component are two things. One, all the tightening the Fed has done has not filtered into the economy yet, so we don't know how much damage that's going to do. And number two, which I think is the easiest thing to really recognize, is the cost of capital, whether you're talking about a mortgage for a family or a line of credit for a family or commercial loans. When this debt has to get redone this year, they're going to pay substantially higher. So the cost of capital has gone up significantly on a percentage basis. And that means profits and earnings are going to have to come down. And this market has to get reset to the new normal of higher rates for a longer period of time and slower growth. And we're not there yet.
So Eddie, then what does that look like when you take a look at the S&P where it is today? We're still above 3,800. How much worse is it going to get before we bottom out?
So obviously predicting where it's going to go is very difficult. But we've told our clients, 3,200 on the S&P is not far-fetched in our opinion. We would start buying before we got to that level. We're sitting on a lot of cash, so we would dollar cost average when we got close, a little bit higher from that. But I think you could see 3,200, and then if it deteriorates from there, then you're looking at 3,000 as a potential floor. So I think there's still double-digit downside, and I think it's going to happen in the first half of this year because we're going to start to get earnings revisions. And I think it's going to surprise the market because the market, in my opinion, was not pricing in a recession. We keep hearing soft landing, soft landing. If this isn't a hard landing, I don't know what is when you look at the carnage and the amount of wealth that's been lost in this country. And lastly, in regards to the recession talk, I think housing this year is going to be extremely problematic, and that's what's going to put us into a deeper recession than what this market is pricing in.
Yeah, more than 2/3 of large institutions, Eddie, that do business with the Federal Reserve think a recession this year. You're in that camp. What do you think could change that equation to you? What could eliminate that from your thinking?
Unfortunately, I think there's been so much damage done that there's nothing that the Fed can do other than cut rates, but they're not going to do that. You don't raise rates as much as they did to just turn around and pivot and cut rates. When you tighten up monetary policy as fast as we have in this country, we've never seen anything like it, in conjunction with an economy that's slowing down, I don't know how you come up with another conclusion other than a recession. So unfortunately, I think so much damage has been done now that there's nothing that the Fed can do to save this market and this economy because it's already heading in the wrong direction. The only thing, again, is much lower rates, but if you do that, then you're going to have inflation spike up again, which is exactly what they're trying to avoid. So they're in a no-win situation right now. They're probably going to tighten again in February, and then they'll maybe stop after that. I think you'll get 2 rate hikes at the most this year, and then the carnage is going to be very evident.
So Eddie, then what should investors be doing at this point? Is there any opportunity within the market, say within some of these defensive plays that might be able to hold up given the larger drop that you're expecting?
So obviously everyone's situation is different. For us, cash has been king. We're sitting on a very large cash position. And finally, for the first time in years, cash is actually paying investors. You're getting paid to wait. Sometimes the best investment strategy is to do nothing at all and be patient. Because if we're right in our assessment of this economy, even though today may look like a buying opportunity for some, we continue to think that patience is going to win at the end of the day and that we'll have better buying opportunities later in this quarter.
All right, Eddie Gabor, always great to have you. Thanks so much for joining us here. Key Advisors, Wealth Management CEO and co-founder. Well, coming up, Sam Bankman-Fried pleading not guilty to fraud charges. We will break down what comes next for the disgraced FTX founder when we return. Stay with us.
All right, breaking news now. Former FTX CEO Sam Bankman-Fried pleading not guilty to fraud charges in court earlier today. The judge setting a trial date for October 3rd, 2023. The founder of the now bankrupt crypto exchange is charged with 8 criminal counts, including wire fraud and conspiracy to commit money laundering. Bankman-Fried facing up to 115 years in prison if convicted on all charges. Yahoo Finance's David Holler joins us now. David, you were at the courthouse earlier today. What were your observations?
So Bankman-Fried and party came out of a black SUV, and it was noticeably the crowd was thinner than it was for his initial arraignment. This is sort of the second part of his arraignment. And so he passed through security and he was flanked by reporters, as you can tell. His mother apparently also falling during the incident. And so when he passed through inside, he was initially sort of skeptical of giving away his laptop and computers. He had to anyway, as everyone in the courtroom did. He pled not guilty in the courtroom. After that, there was a lot of discussions about next steps for the discovery period. It does seem clear that the DOJ and Bankman-Fried's legal defense have been in conversations, especially regarding some assets that were moved by Alameda Research, Bankman-Fried's hedge funds, crypto wallets this was noticed on Friday, and the DOJ said they have no evidence that he did it, but they're placing an extra contingency to his bail, which is that he cannot touch Alameda and FTX group crypto wallets.
David, what was his body language like in the courtroom? And I guess, how did he appear, comparing that to how we have seen him on Yahoo Finance and on other networks in the past before the arrest?
Yeah, that's a good question. His demeanor was not. He was upbeat, I would say, in terms of what you would expect. And I think that a lot of it had to do with the fact that, one, this is routine, and there have clearly been negotiations that have been set. And at this point, too, I think that there's clearly some agreements that have been made. The trial date is obviously set for October. He might plea guilty before then. He has the option. But that being said, it gives him more time in this period of discovery, which is sort of happening right now.
Yeah, certainly a story that we are going to continue discussing. David Holler, great job. Thanks so much for joining us here on Set with That Color. We want to continue talking about SBF and his not guilty plea. We want to turn to Michael Zweiback, criminal defense attorney, co-founder of ZFZ Law. Michael's also a former federal prosecutor. So Michael, first off, your reaction to this, SBF facing 8 charges, entering that not guilty plea. What's your takeaway?
Well, this is very standard at this particular point in the procedural history of the case or procedural posture of the case. His lawyers, in terms of agreements, as your prior guest discussed, at this point, the lawyers are engaging with the DOJ prosecutors to get discovery. They want to see what the government has put together and how it's being put together, what pieces are there, what pieces are missing, and sort of, an evaluation of the case as it stands right now.
So what is your expectation moving forward? Is it that eventually he will make a deal? Or does the DOJ, does the SDNY want and need a public trial here?
Well, I think if they get a guilty plea, they'll be very satisfied with that. With respect to what I expect going forward is that time favors the prosecution in this case because it is a very complex case. I mean, the old adage is time actually favors the defense, but I think in this case, it favors the SDNY because what you're going to see is a parade of other cooperating witnesses who are going to come into the courthouse and say that I'm also responsible for participating in this conspiracy. That's going to place a great deal of pressure on him to try to seek some form of a deal in this case. We've seen that Mr. Bankman-Fried marches to his own drummer, and so maybe he wants a trial himself and wants to explain his role in all this because he certainly seems to think that he knows better than just about anyone else.
Yeah, and going off of that, he certainly has done a number of interviews since this news initially broke several weeks ago. He's done a number of TV interviews, podcasts, print. He's been tweeting nonstop, or he was at least for an extended period of time. Does that complicate his case? I guess, does that further make it harder to prove his defense in all of this?
It makes it so difficult on a defense attorney when you don't have control of your client and your client seems to want to discuss the case and sort of their viewpoint of the evidence. And so it makes it much more difficult for his defense team to ultimately defend this case. And consequently, it also makes it easier for the prosecutors to follow every strand of evidence that he's discussed and either prove it to be false or true to the benefit of proving the charges.
Given that public media tour, the China references, and the cooperation, most importantly, of Wang and Carolyn Ellison, who, according to ABC News, told the DOJ, we prepared certain quarterly balance sheets that concealed the extent of Alameda's borrowing and the billions of dollars in loans that Alameda had made to FTX executives. It went on and on to incriminate Sam Bankman-Fried. What could a possible defense be? And the line he used over and over was, I never knowingly commingled these funds, et cetera, et cetera. Would that hold up?
No, it's not going to hold up. This whole notion of, well, I did it, but I didn't intend it to be fraudulent or a crime is not going to go very far in front of a jury. That type of statement that Ms. Ellison made is critical to proving the prosecutor's case, powerful evidence. And it also demonstrates that while this case has had this air of sophistication and complexity, it's really a very old story in terms of a very sort of straightforward fraud. It's all about the misrepresentations.
Michael, if SBF does not change his plea, if this in fact does go to trial, which was set for October of 2023, what does the timeline look like on that, just in terms of how long it could actually take before we get a verdict?
Well, I don't expect this case, if there is going to be a trial, to go to trial in October. I think the judge was setting that as a placeholder. There's going to be a mountain of evidence, and I would say October of 2024 is more likely. And in terms of the length of the trial, I think that this is a month to 2 month type of trial, given the significance and quantity of evidence. And, in terms of a jury verdict, it could actually be, even though the trial length could be that long, it could be a very quick jury verdict.
Why would it take 20 months to bring this thing to trial, Michael?
Just because of the volume of the evidence. The defense is going to go in and say, look, we need additional time because we need to evaluate this with experts. We still haven't finished going through all the interview statements that have been presented to us, grand jury testimony, if there is any. For a case of this size, a 2-year timeline is a very sort of reasonable estimate for this case to get to trial.
Many were angered at the fact that if in fact it is 20 plus months, that he's going to get to spend that as a free man at his parents' estate. Is that typical? Is that unfair?
Well, is it typical? In a lot of fraud cases, it is very typical to get bail. It is also very typical in a case of this size, and given the fact that there are assets spread throughout the globe, and as you just heard, there are still transactions going on to this day, for this individual to be incarcerated while he is pending trial. And in fact, he is still a flight risk, despite all the protestations of the Department of Justice, as well as his defense team, that he is not. And the $250 million bail figure is fake. It's completely fictitious. Really, this was a recognizance bond secured by a piece of property. And, it was a very light bail for a case of this size.
Good stuff. Look forward to talking to you as we get further along in this case. Michael Zweibeck, thanks for being here. Happy New Year. Coming up, Southwest Airlines holiday meltdown may be in the rearview mirror, but investors are still worried about what's next for the airline. We'll be back with details after the break.
Time for a triple play. 3 stocks that we're watching in the final 25 minutes of trading. We have PayPal, Ford, and Southwest. Let's kick it off with PayPal. It's a top trending ticker on Yahoo Finance today. The stock kicking off the new year on an upbeat note. Look at that. We're looking at gains of just about 5%. Now that coming after Truist upgraded the stock to a buy, making the case that investors seem to be, quote, too negative on the stock at this point. And now analyst Andrew Jeffrey liking PayPal's $6 billion cash position, saying that it brings flexibility for potential M&A and also for buybacks. Now Truist's new price target of $95 a share. You can see about $20 higher from where we're trading today, about 38% higher from where the stock closed at the end of 2022. So, Praz, a much more bullish, I guess, optimistic outlook from Truist here from PayPal that was coming off what was a pretty challenging year, not only for that name, but for many of the names within the sector.
Yeah, you know, PayPal, the granddaddy of the space, right? I'm looking at some numbers here. You know, Ford P 15, that's very fair. Last quarter, $7 billion in revenue, 20% margins. I mean, this is a great kind of business, and I think that at these levels, they're making the case there, especially with that $6 billion cash hoard. You can kind of maybe acquire a beaten down company that could sort of increase their moat. They have, you know, Venmo. People use that all the time. I use it all the time. I think it's a great business. So for PayPal, it's just I think a good call by Truist there. I'm watching shares of Ford here, actually. The automaker says its F-Series pickups will attain the best-selling truck title in America for the 46th consecutive year. An overall best-selling vehicle for 41 years, if you can believe that. Now, we'll get some official sales data from Ford on January 5th, but the company is fairly positive with top truck rivals like GM and Ram. Now, also sticking with Ford, the research firm Auto Forecast Solutions, the big data firm here, predicts that the next-gen Ford Lightning will be in production in the fall of 2025. Maybe by then we'll be able to walk into a dealership and get one of these, but we'll see. It'll be on an all-new dedicated platform for that.
Interesting. A note out from Wells Fargo analyst Colin Langan today. Underweight, bearish on Ford, $10 price target, and says basically continued inventory increases without improving sales will add to pricing concerns. Overall, I think it's just a look at the macro conditions ahead that they may be better suited than others, but it's still a tough road ahead for a lot of automakers. All right, my play, also a tough road ahead. Southwest Airlines. Things are finally stable there after their massive meltdown over the holidays, but there is turbulence ahead. Bank of America says the debacle, which involved some 16,000 canceled flights, will cost the airline between $600 and $700 million. That includes both lost revenue from refunds and the reimbursements to affected passengers, such as hotels and rental cars, and that process could likely take several weeks. B of A analyst Andrew Didora cutting his fourth quarter adjusted earnings forecast for Southwest to 37 cents a share. That's from 87 cents. Southwest will report earnings on January 26th. It's just been a brutal slide for this stock, as you can see, down another almost 4% today, and it's just been one challenge after another, down 10% in the last 7 days. They do say the baggage crisis is going to be solved by midweek. But how do they regain customers' trust, Shauna?
Yeah.
That I have no idea.
And that's probably going to take much longer. That's clearly the safe answer. It could take years. If you've been caught up in this mess, you weren't able to get to whatever your destination was over the holidays, I don't think you're forgiving Southwest Airlines anytime soon. Now, during the White House press briefing just a couple of hours ago, we heard from White House Press Secretary Karine Jean-Pierre, and she said that the Department of Transportation is going to hold them accountable. We heard that from Department of Transportation Secretary Pete Buttigieg last week, but then she did go on to say that the Biden administration, saying that Southwest, quote, failed its customers point blank, also went on to threaten fines on the carrier if it doesn't make customers whole. So the pressure is on, not only from a government perspective, from regulation perspective, also clearly from the customer perspective. And I think if you were one of those that were caught up, had your flights canceled numerous times over the last, week and a half or so, I would venture to guess you're not going to be booking Southwest anytime soon.
I mean, I didn't even fly Southwest, and I would be scared to fly them next, right? Based on the next kind of storm. $600 to $700 million, I thought it'd be more than that for that charge, no?
600, 700, right. Yeah, I think down the road, I think that's not taking into account the damage already done to the stock. That is just to really refund tickets and reimburse passengers. But the damage done to the stock has been 3-4 times that. And I agree with you. I just don't know how do you get packed customers? You further discount your tickets, which is going to further hurt your margins, which is going to further drive the stock down. I don't know. Elizabeth Warren says this is a consequence of, consolidation in the airline industry. I don't think so. This is an outdated computer system and a system nationwide that no longer makes sense for Southwest.
Yeah, I don't think your argument holds when you just compare Southwest's performance to all the other major airlines last week and the low number of cancellations that we saw relative to what we saw from Southwest. Clearly, a lot of investment is needed in terms of updating their technology, which also is a solution that's not going to happen overnight. That's going to take time. So we can't also count out that maybe something like this, maybe not to this scale, but something like this could potentially happen again for Southwest until some of those changes are made. All right, well, coming up next, 2022 is certainly a challenging year for Americans, but many believe that things aren't going to get any better in this year. We've got the details for you in a new survey next.
New Year's celebrations tend to give way to hopeful outlooks for the year ahead, but according to a new Gallup poll, Americans are increasingly pessimistic about the country's prospects in 2023. 79% of the country says we're heading into a year of economic difficulty, while just 18% say it will be one of prosperity. 81% think taxes will rise. 65% say prices will continue to rise at a high rate. Happy New Year, not so much, Shauna.
Certainly not so much. Now, this doom and gloom, it seems widespread, but Democrats appear a bit more optimistic than their GOP counterparts. So more than half of Dems say that they expect prices to rise, but at a reasonable rate. And that same percentage expects the stock market to rise. Well, comparatively, though, only 16 and 15% of Republicans agree with each of those statements, respectively. Now, when it comes to the general economic prosperity, just 36% of Democrats believe that we are going to see it this year. Just 4% of Republicans agreeing. I don't think that's a huge surprise given that Republican number so much lower given who is in the White House right now. But Dave, I think this just speaks to the challenging economic climate environment that we are in right now. Coming out of 2022, certainly the worst year for stocks that we have seen since 2008. A lot of the same issues still persistent today. We can see that reflected in the losses that we're looking at the first day of trading in 2023. Lots of worry about high inflation, how long that's going to take to bring it back down to more reasonable, quote unquote, levels. And then also just an aggressive Fed, what that means for the odds of a recession. Clearly, by the looks of this survey, doesn't look like it's going to be anything good, at least for several months.
I need to take Prozac before I start reading these polls right now and talking to analysts. I mean, Eddie Gabor's talking about a 3,000, maybe a 3,200 S&P. I guess I am a bit surprised by the economic projections. And these are ordinary Americans. These are not economists. When you're talking about the worst year, as you said, worst year since 08 for the Nasdaq and the S&P, my expectations was that people, ordinary people, would expect the markets to get better or the economy to get better because it was so bad in 2022, but that is certainly not the case. And it's not good anywhere, Shauna. You look outside of the economy, 90% expect political conflict, 72% expect rising crime rates. My goodness, it's hard to get out of bed when you read stuff like this.
It is hard to get.
I try to be optimistic. This ain't helping.
Yeah, and also when we also take into account that this was Americans that were surveyed, 64% believe that the U.S.'s power in the world is going to decline, and compare that to where their view is right now of China. More than 70% think that China's power on a worldwide scale is going to increase. So we knew it was bad in 2022. We're always searching for that optimism.
Yeah.
The first 46 minutes of the show, our first show in 2023, we're not giving you guys a lot of optimism up until this point.
Somebody have something they can tweet in or email us, because there is nothing to savor out there. You mentioned the 64% that say U.S. power is going to decline. Well, also 64% believe Russia's power is going to increase. How in the world do you think that? That's the one issue here. I'd have to say, no way, no chance. They are an outcast from the world's economy at this point, and I don't think that's going to change for 5+ years, no matter how this war in Ukraine ends. I don't know how in the world you ever see their power on a national stage increase. They are a pariah economically on a global stage.
Yeah, certainly not anytime soon. I agree with that. I was surprised by that outcome as well.
Man.
I know, it's hard. We got to move on, because I don't think we can meet. We're looking for some optimism, and maybe we're actually going to find it with Starbucks, because the company unveiling details of its winter menu, something for you all to get excited about. There's also a new call out on the street. We've got those details for you when we come back. Starbucks shares moving to the upside today, up nearly 2% in the final minutes of trading. Bank of America out with a new note reiterating its buy rating, but raising its price target to 125 a share. Brooke DePalma is here with the details on that. And Brooke, this optimistic outlook, or more optimistic outlook, I should say, a lot of that has to do with the reopening in China.
That's right. This note specifically regarding the reopening in China, alongside noting a strong rebound and poised to benefit as China once again abandons that 3-year COVID-19 policy that's been in play that's really restricted mobility. Sarah Senatore, BofA analyst here, really highlighting that with more mobility, there will be more orders at Starbucks. So really what she's taking a look at is 3 specific notes here: brand, scale, and tech. She notes that it's really an accessible luxury, similar to what we see here in the U.S. as we see a boom in perhaps consumers going out and buying Starbucks. They'll ultimately choose Starbucks, seen as a discount versus competitors overseas in China versus Grey Box and Coffee and Pete's, but also a 10% premium to that of premium Pacific Coffee and Luckin Coffee. So she notes that this is sort of a sweet spot and in between for consumers. Also scale, Starbucks not shying away from boosting its presence in China despite these lockdowns. That's more than 6,000 locations in China now. That's up from 4,700 in 2020. So of course, that's one thing that's coming out hot out of this COVID-19 policy lockdowns. And also technology here. She said that mobile orders really result in a larger transaction there in Q4 in China. We saw 17 million reward members, and also mobile orders representing 44% of sales. So certainly all these major sweet spots hitting the right spot for Sarah Senatore at BofA, but she is one of 14 buys, 20 holds, and 1 sell on the street right now for Starbucks.
It's really interesting to read these upgrades about the China reopening as bodies pile up at the morgue and the hospitals are beyond crowded. But let's set that aside for a moment. You said the word sweet spot. Speaking of sweet, the new holiday menu, winter menu is out. I assume it's rather sweet as usual.
It looks pretty sweet. Now added to the menu this year, completely new, is a pistachio cream cold brew. Now that's adding to the return of the pistachio latte. But the big story here is just how bullish, I guess you could say, Starbucks is on cold options. In Q4, we heard that 76% of orders were actually cold coffee options. And so that really makes up about 2/3 of Starbucks orders entirely. And, you know, what we saw in the fall of this year was the highlight of customization. They had that pumpkin spice cold brew option. And while people may not have gone in the pumpkin cold brew, they added that pumpkin spice cold brew foam on top. And that led to, in part, to a 17% spike in their fall spice platform. And so perhaps Starbucks, once again, betting big on colds and hoping for similar customization, usage here.
The cold foam is delicious. But I will say I ordered the pistachio cream because I knew you were coming on today. I just got that in my cold brew, just the sauce in my cold brew. It was a lot like 22. It was forgettable.
Ooh.
Like it just was forgettable. That was
the year 2022 are we
yeah.
referring to? Interesting.
I thought you were really excited about it. I don't know. It seems
very
like for
forgettable.
Allie, something you could like spice up your morning drink with a little bit, makes it a little bit more exciting. No, didn't make the cut.
I'll keep
All
trying.
right.
I'll keep going.
I'll
back
give
to
it
the
a
calendar.
Let
That's
me
Dave's
give it a
official
try,
review.
and I will give a review. Maybe
Now
I'll be
we
a little
have
bit more
it.
optimistic as we start the new year.
I love their cold brew, though. It's my favorite. Brooke DePalma, always good to see you.
Thank you so much.
Happy New Year. Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, we are just a few minutes away from the closing bell. Let's bring in Yahoo Finance's Jared Blickery, who is easily the most optimistic person, I hope, on this program today. Please.
Ooh, tall
maybe?
order there.
Anything?
I'm looking at the data. I gotta talk about what I see here.
All right.
I'm afraid we're having a down day on the first day of the year. That's a bit of an inauspicious start. By the way, we got the Santa Claus rally still technically in effect until tomorrow close. So the Dow is up a whopping 30 basis points. If you're looking at this thing, wow, that's some sideways choppy action we've had over the last 6 days. That's what I'm thinking as well. And the Nasdaq, that's down 75 basis points today, underwater over the trailing 6 days. Let's skip to some heat maps here. Also noting the bond market had a pretty, well, at least in yields, had a pretty steep sell-off today. Two stories of the day, Apple and Tesla. Let me just chart this real quickly. This is going to be a one-year chart of Tesla. And let me show you what's happening here. This is a wedge. We had a breakdown, a back test of the breakdown, this line right here, and we are heading down. This is a 52-week low for the most important stock in the universe. And here's another one. Oops, here's Meta. By the way, that's up about 3.5% today. I was going to do a different analysis with Tesla. That's what I'm looking for here. Another stock at a 52-week low, just kind of begging to probably see that $100, maybe a $99 print. That is a falling knife if I've ever seen one. But let's take a look at some of the sector action for today. And energy just really taking it on the chin. We saw WTI with a huge outside reversal day. XLE down 3.5%. Communication services, we briefly looked at Meta by mistake there. That's up 1%. And kind of a mixed day here. Let's take a look at our leaders. China is just about the only thing majorly in the green. KWEB, that's a China Internet ETF. That's up over 5%. To the downside, ARC down 2.5%. We got Korean stocks, IPOs, momentum. I don't know if I can read a lot into here, but let's look at some of the boards. Here's energy. This is suffering kind of a big day here. ExxonMobil down 3%, Schlumberger down 3.5%, MPC down 4%, as well as ConocoPhillips. But let's check out that China leaderboard just so we can get a glimpse of a little bit of green before we head into the first trading bell of the new year. Baidu up 4%, Bob up 4%. This is a sector that really came alive again in December, in parts and pieces. Aside from a few names there, we're seeing some pretty good outperformers over that last month period. Let's also take a look at the EV space. Outside of Tesla, also seeing some strength in some of those China names. We just took a look at those, but check out Rivian, check out Lucid. Rivian down 6%, Lucid down 6%, and I'd be remiss if I didn't check out the crypto market heading into the very first trading bell of the new year. Guess what? Bitcoin down just marginally, down 0.5%, and Ether down a similar amount. Here's that bell that we've been talking about.
Well, that does it for the first trading day of the new year. And investors disappointed, I would think, with how this new year started off. You're looking at all three of the major averages in negative territory. Dow, though, off its lows of the day if we're looking for some optimism, closing down just 12 points. S&P, though, off nearly 0.5%. The Nasdaq, the worst performer of the three major averages, off just about 0.7% on a sector basis. We're looking at a bit of a mixed picture. Energy by far the laggard, what Jared was just talking about, the XLE closing off just over 3.5%. But some of the gainers this afternoon, communication services ending the day in positive territory, as well as financials and real estate. Let's talk about all this, what this means for 2023. And for that, we want to bring in Hugh Roberts, Quant Insight Head of Analytics. We also have Stephen, also known as Sarge Guilfoyle, President of Sarge 986. Hugh, 986, excuse me there. Hugh, let me start with you. We started this year, obviously, in negative territory. What does this signal about the year ahead? Are we in for a tough ride?
Well, firstly, with the caveat that one day's price action shouldn't be overextended. But I think what we're noticing on our models, if you remember, what we do is we look at things exclusively from a top-down macro perspective, and we look at them in a quantitative framework rather than by exercising individual kind of discretionary opinion. And what we've picked up from our modeling is that there's a bit of a regime shift taking place under the surface. And by that, what we mainly mean is that 2022 was all about the Fed as they tightened financial conditions to fight inflation. The Fed are clearly going to remain very important. You can never underestimate their power. But what we're picking up on is even more sensitivity to the real economy. So we're seeing greater sensitivity to growth, to inflation expectations, to industrial metals, and to the credit cycle. And I think that what that says to us is that potentially markets will be spending the early part of 23 really getting more nervous about a hard landing. And that the dynamic that we've witnessed before, whereby bad economic news was almost seen as good news in the sense that it stayed the Fed's hand and maybe brought in a lower terminal rate, that's starting to shift. And bad news just reflects a recession, reflects poor earnings, is bad news for stock markets. And I suspect there's a degree of that thinking going on.
Sarge, Happy New Year, man. It is
Happy New Year.
It is tough to take. I'm gonna have to double my antidepressant intake the more I watch the markets and listen to the analysts. Is there anything to be optimistic about as we start this new trading year?
Well, for the most part, I could probably echo everything my colleague just said. I agree with them on a lot. But there is a silver lining in the cloud out there in Fedland, all right? At least the FOMC is, the voting portion of the FOMC is getting rid of Bullard, getting rid of Mester, getting rid of George, and getting rid of Collins. Incoming are Harker, Logan, Kashkari, and I guess Goolsbee if he's in already in Chicago. So you are going to have, when we hit this recession, which I think we're going to hit late Q1, early Q2, I could be off by 6 months. But when we hit this recession, at least the voting membership of the FOMC will probably be a group that will pay a little more attention, maybe take their boot off the throat of the average American.
All right, not bad, not bad.
We're when we hit the recession,
and then things will get a little bit better. Hugh, what about some of the leaders, though, that we did see today? And I know you don't want to make too much of one day's trading action, but communication services did start off the year on a more upbeat note, closing up just over 1%. Financials were in the green, as well as real estate. When we look into some of the leaders maybe in the new year, how do you see that shaping up?
Yeah, it's going to be interesting. Sorry.
Hugh, let's go to you first.
Sorry. So from our perspective, there's a bit of a barbell approach going on. We've actually got bullish signals on some of the kind of value and cyclical plays, financials amongst them that you mentioned. But then at the other end of the spectrum, the machine's also throwing out your classic defensive plays as bullish signals as well. That includes dividend plays. It includes thematic ETFs like cash cows. So there's a bit of a kind of two-pronged approach going on. The other thing that it's picking up on was actually something that you guys were talking about just 5 minutes ago, and this kind of concept of affordable luxury during a downswing. So if we look at something like Starbucks, for example, and I appreciate the earlier segment was looking at it from a company fundamental perspective and earnings potential in China. But if we look at what the macro environment is saying about Starbucks, then actually it's one of the few stocks out there where macro warranted model value, or target price, if you like, is actually trending higher. So there are some corners that can be viewed as good places to hide.
Okay, and Sarge, you said cash was king in 2022. Is there opportunity aside from cash as we enter 23?
Yeah, they're called 3-month T-bills. Maybe you want to be in 3-month T-bills so you can get the 4% going through the first half of the year. But as far as stocks go, we have 4 S&P spiders that are trading above their 200-day SMAs. Those are financials, industrials, healthcare, and staples. Now, I'm a little afraid of financials. I'm in them small, but I'm a little bit afraid of them because going into a recession, that could get really wonky. As far as industrials, my favorite sector remains defense and aerospace. This is the group that carried me to victory in 2022. I am not changing my trajectory with the geopolitical world the way it is. I'm still long Lockheed, General Dynamics, Northrop Grumman, Raytheon, Boeing, which is kind of a new one for me, and CACI International. As long as I have those names, and as long as people want to kill each other on this planet, I think I might be all right.
All right, Hugh, let's take a step back because I know you look at things from a global perspective. So outside of the U.S., I guess we could start with the IMF warning that a third of the world economy is going to be in a recession this year. Comparing the U.S. and how it stacks up against the world's other largest economies, where does that stand?
Yeah, I mean, I guess that's one of the most interesting asset allocation decisions that people are facing in 2023, because if you do believe the dollar's turned, then intuitively a lot of people are going to be looking to see if this is the end of American exceptionalism. Is it time to start putting money into overseas assets? And then you start overlaying a kind of China reopening theme, and you've potentially got an argument for, getting involved in EM at the broad level and China more specifically. At the moment, I don't have a good quant insight answer for that, simply because our models still suggest that actually it's politics and it's idiosyncratic risks that are driving Chinese equity markets, not macro. Our model confidence numbers aren't at the levels that we'd want to see for us to have a big call at the moment. But I think stepping back as a kind of non-QI answer would actually be, it's just classic risk reward. I mean, unless you think you can be uber tactical and uber smart on your timing, then everyone knows that the China reopening is going to be bumpy. It's going to be 2 steps forward, 1 step back. But if you're anything like a medium to long-term investor, then you're just going to be dripping money in and saying, listen, one of the world's largest economies is reopening. I can't finesse it over the next 3 months, but I know that over the next year, hopefully that has to be good economic news. That has to be good for the Chinese stock market. So I suspect it's that kind of thinking that is underpinning things.
All right, well, we got to leave it there. But Hugh Roberts, Stephen Guilfoyle, thanks so much for joining us, and Happy New Year to you both. All right, well, coming up next, the House is voting for its next speaker, and in doing so has done something it hasn't done in over 100 years. We will sort through the chaos, and VideoAmp inking a deal with Warner Brothers Discovery. We will talk to VideoAmp's CEO when we return.
The 118th Congress opened today and began, like most before it, with disagreement. For the first time in a century, it's taken more than one ballot to elect a speaker. A third vote is expected shortly after a second did not see any candidate win the 218 votes needed. Senior columnist Rick Newman here with the latest on Kevin McCarthy's almighty struggle. Rick, good to see you. Happy New Year. He's essentially running unopposed. How in the world and why is Kevin McCarthy having so much trouble?
Well, he's running unopposed for now, except there's just enough opposition to what possibly derail his bid for Speaker forever. And, poor McCarthy, he's been sucking up to Donald Trump forever just so he can become a Speaker of the House someday. And look what happens to the poor guy. It looks like he can't get it. What's going on here is there are a few rambunctious super conservatives in the Republican Party who just will not vote for McCarthy. And, Dave, sometimes there's this sort of phony drama on Capitol Hill where everybody has to take a stand publicly and then everybody gets together privately and they sort it out and the thing passes. That is not what's going on here. This is full-blown chaos within the Republican Party. Remember, the Republicans only have a majority of 5 seats in the House, and that means in order to get enough votes for Speaker, McCarthy needs almost every Republican to vote for him. I guess he can lose about two or three votes at most, and he is losing more than that. There is concerted opposition to him. So he may end up not being elected Speaker. And this is one of those things where even the people who follow all the ins and outs of this don't really know how this is going to end or who the Speaker of the House is likely to end up being.
Yeah, Rick, let's talk first, I guess, about implications of this, just in terms of where the priorities lie within the GOP. If, in fact, he doesn't get elected, or if it takes numerous votes in order for McCarthy to be elected, I guess, what can we glean from this just in terms of where their priorities will be this year?
It almost seems like the more votes this requires, the worse it is for McCarthy and the lower his odds get. Now, there are some others who could get there. I mean, somebody has to become Speaker of the House, so it has to be somebody. But if Republicans don't resolve this soon, what this is telling the country is the Republicans don't have their act together at all. They basically campaigned on Joe Biden's been doing a terrible job. We're going to get there. We're going to take over Congress. We're going to show you how it's done. And now they're showing us they can't even get organized among themselves. And especially when you compare this with the way Nancy Pelosi, the House Speaker of the Democrats, ran the House. I mean, she got elected Speaker with the same very narrow margin 2 years ago. And she had everything under control. I mean, she got the votes there when they needed the votes. She figured out how to make the deals to appease, in her case, the people on the far left of the party. And she knew how to get everybody in shape. And Republicans, for now, they're showing they just are not able to do that. This does matter down the road because the big thing for markets is we are going to have to extend the national borrowing limit again in 2023, maybe by the middle of the year. We've seen how that goes before. It seems like a big to do over nothing. We're going to threaten this terrible thing, default on U.S. debt, and then it always gets resolved. Why do we even go through this? Well, we're seeing an example of why we may go through this again, because there's really just an element of nihilism among apparently enough Republicans to sort of throw the whole House into chaos. So I don't think anybody expects we're going to see a lot of bipartisan legislating this year, but this does raise questions about what happens when we get to those 2 or 3 bills that do have to pass.
At this point, just go full clown candidate and Speaker Santos.
Really?
Right? I mean, let's just do it. Let's just go all the way. By the way, you don't have to be in the House to actually be the Speaker, so I think Rick Newman for Speaker would be amazing.
All right.
I'm just throwing it out there, people.
Next time we talk about this, I'm going to get my Bozo the Clown nose for the segment. Okay, guys?
Thanks.
I don't want the job. I don't want the job. Nobody wants to have to manage these people.
That is true. And it's a tough job. Rick
Thank
Newman,
you, Rick.
as always, thanks so much. Warner Brothers Discovery shares moving to the upside today after announcing a new audience measurement deal with Nielsen rival Video Amp. Let's talk to Ross McCrae. He's Video Amp founder and CEO, joining us now to weigh in. Ross, great to see you here. So I guess what can you tell us about this contract? Because certainly I would think a huge deal given the size of Warner Brothers Discovery for your business.
Thanks for having me. Yeah, it is a big deal for Warner Discovery, for Video Amp, and for the whole ecosystem. This is showing a sea change in how advertising and media is being measured and valued. Legacy and historical ways have been using a small panel, about 40,000 people in the United States, and whatever that small panel is watching, we assume everyone else in the United States watches that. Video amp takes more of a big data and privacy safe approach where we're auditing the actual streaming and login information and without ever having to even see the consumer information. So the level of accuracy of actually counting every individual streaming and looking at it as a digital record is much more accurate than estimating. And that changes the entire value of ecosystem. There's more viewership in certain places that was undercounted. And if you're more accurate on measurement, then the advertisers can better optimize because they're actually knowing what's happening versus on false information, and it increases the sales for advertisers, and it's going to increase the value of the entire portfolio of the original thesis that Warner and Discovery merger had.
Good to see you, Ross. So just to be clear, what is it that Nielsen fails to do that would accurately measure today's audiences?
Sure. I think in general, it's just a different approach of taking a small panel and extrapolating and saying, I'm a male living in Los Angeles, and everyone else who's a male living in Los Angeles watches the same thing. It's just a night and day versus counting every individual record on streaming. So we've seen a lot of undercounting on media representation. And so when there's a more audiences being there, then Warner Bros. Discovery can prove that there's more audience being counted. And what then happens is that the advertisers can optimize in a better way and see the actual impact towards sales, which is the next thing that we do. We go beyond just eyeballs, but can give advertisers an actual bridge towards, is it driving sales or not? And with that extra visibility, that increases the value for both the buyer and the seller.
So Ross, you have all the data right there. So tell us, because we talked about the changing landscape when it comes to media, what are viewers preferring right now? And I guess what engagement trends are you noticing at Video Amp?
Yeah, look, there's no doubt that there's trends to digital and streaming and having the choice of having that. I mean, there's just no doubt about it. But I think the question is it how fast is it really moving? Is it moving at this speed or is it moving at that speed? And we're seeing that moving faster than what people are seeing and what people believe.
And so when it comes to Amazon getting in the game and Apple getting in the game, will you be able to accurately measure those types of audiences as they jump into things like live sports?
Yeah, we are.
How do you do so?
Same tactic, right? I mean, imagine this, right? So first of all, the way we work is that we deploy our software into their environment. So no one's sending us all the level of logs and Ross McCrae's information, watching all of that. It's not like some big brother thing. We're deploying our software and thinking of it as like an auditing layer inside of their environment and their logs. So for an Amazon or any of those digital players, when someone's logging in, you're logging on and you're authenticating with the service, right? It's all logged in information. So as a technology provider, you know how many people are logged in at a given time. And that's what we call more of a truth set. So we're processing and validating that and making sure that that's being accurate and being held in the right way and just representing and giving the actual numbers. And there's been large discrepancies. There's been public spouts. I mean, I think with Amazon's football and the Nielsen records, that Amazon was saying it's 25% higher or something like that, and Nielsen was saying it's lower. And so we process the data and we validate the actual records in a way. So we think it's a very large sea change for how this has been going on for 100 years. Nielsen just turned 100 years old, I think, last week.
Are you bearish or bullish on the overall media environment? We're talking about $500 billion shed from the global media companies. It has been cord cutting. Those are the trends that are accelerating. Fewer eyeballs on traditional television. What's going to be the catalyst to turn that around? Well,
look, I think there's a lot more that's being undercounted and undervalued is a little bit of the thesis. Now, there's no doubt that consumer trends are happening, but when we look at our data, which we think is more accurate and what a lot of the advertisers in the ecosystem are looking at, we see a different story. Audiences are still happening on traditional linear television, and that's not even being properly represented, let alone the shift to streaming. So you're looking at when the industry is so used to looking at a truth set that is impressions and how trends are going, if it's just dramatically wrong, then I think the markets are using that in some sort of way to show the value of these media companies. So I think with more accurate light being shed on what's happening with consumers, then you can have the ability to capture more of that value. And if the advertisers ultimately are seeing their sales go up, which we do see we have hundreds of advertisers that are our customers, and they're coming back to us because they're seeing their sales increase with more accuracy. They're figuring out where to put their money. And if you're putting your money where you think it's actually working and you see that return back, then you see sales go up. So it's this positive feedback loop. So the more that advertisers are increasing their money, especially in this economy, you have to do a lot more with less. They're getting more value from the media partners. And if the media partners are helping them drive their sales, then we believe the value of the portfolio will go up, and therefore the value of their companies will also go up.
I get it. Video Amp founder and CEO Ross McCrae, good to have you, my man. Happy New Year. Coming up, China is reopening its borders, but the rapid economic recovery that many were hoping for may not come to fruition. Find out why after the break. China's President Xi Jinping announcing in a New Year address on Saturday that the country's GDP grew by 120 trillion yuan, suggesting about 4.4% growth for the economy. Research from China Beige Book suggests that the real GDP growth might be closer to 2%, less than half. Let's bring in Leland Miller to talk about that, China Beige Book CEO, for more on this. Leland, good to see you. Happy New Year to you, sir. What is the status of the Chinese economy overall, and what does it tell you that President Xi, after 2 years of strict COVID-0 lockdowns, essentially threw it all out?
Well, the 22 economy is a disaster, for the year. And so I think that is why President Xi was under great pressure to toss out COVID-0, deal with some pretty rapid COVID spread, and then hopefully come out on the other side early next year with a recovering economy. But it's hard to explain just how bad the 2022 was. We remember back in the second quarter, the economy was in contraction with all those lockdowns. Our fourth quarter data showed economy was in contraction again. And even when you looked at some of the more positive signals, like a little pickup in borrowing and some other things, when you dug down, SMEs borrowed more, private firms borrowed more, but they were borrowing from shadow lenders. It was really a story which everything was down and everything was about to stress. So that's why there's so much hope looking forward into next year for better times.
So we were told from China expert after China expert that Xi did not care about the status of the economy. What he cared about was consolidating his power and control. Was that just a false narrative?
No, I think the narrative was right, but after a certain amount of pressure and also securing his third term, something gave. I mean, it is a very mysterious turn of events. It doesn't make a lot of sense. If they were planning for some turnabout after the party Congress, then there would have been presumably more preparation, whether it was a vaccine rollout, whether it was targeting the elderly with the targeted vaccination campaign, therapeutics rollout, building up more ICU beds. So it doesn't look like they were preparing for the U-turn until the protests hit. China watchers are all over the place on this. Nobody can figure out what was in Xi's head. But what we do know is eventually the pressure got to him, and now he pulled back COVID zero with very little preparation, and that's why we're seeing a COVID tidal wave right now.
Yeah, and Leland, with that in mind, the number of cases that we are getting here from overseas, from China specifically, what does that mean just in terms of how hard that's going to kind of derail this recovery? Because it seems like from what you're saying, a Q1 recovery seems out of the question right now. So how long until we start to see a more substantial recovery there?
I think we start looking at the potential for recovery in the second quarter. It really is amazing the degree to which COVID is spreading across China right now. I don't think anyone in their wildest dreams imagined, Xi's goal would be to lock down the country for almost 3 years and then suddenly let it rip and everybody gets COVID in a matter of 2 months. But that seems to be what's happening. What I think markets are jumping the gun on is that they're looking at subway indicators for Beijing and Shanghai. They're seeing peak COVID or approaching peak COVID in the next couple of weeks in a lot of big cities. And they're saying, look, this thing is over. It's not over. China's big. China has a lot of rural areas. It's going to take a lot more time to go through 1.4 billion people than it will the first 75 million, which is where it's at right now. So I think by the time we get closer to the second quarter, we'll be seeing a turn, but not quite yet.
Leland, they managed to do a decent job of keeping a lid on just how bad the property sector is. What can you tell us and what lies ahead?
Well, look, property is just about as bad as we've ever seen it. Everything was bad. Everything was down. There were a lot of stimulus announcements in December. And one thing that people make a big mistake, analysts love to look at stimulus announcements and immediately say, hey, there must be an economic activity immediately after. You just snap your fingers. That didn't happen. You've got a big load of stimulus that's been announced, some of which is being put into play. But, we have both the new fiscal stimulus index and a fiscal activity index. And we can see that there is a little bit of juice flowing on the fiscal stimulus side. It's not hitting the activity yet. You're going to have to see the COVID spread months go past before you're going to see property really tick back. So I think people have gotten ahead of themselves on that as well. COVID is a dominant story right now. Hard to stimulate anything during a COVID tidal wave.
Well, Leland, given the deceleration that we certainly have seen in China, the weakness that remains when it comes to the economy, what does that mean on a global scale?
Well, it just means that there are a lot of people holding out that China is going to save the world in 2023. I do think that there will be a nice cyclical bounce back in 2023. Could be the second quarter, could be later. We'll see how things happen. There might be investment kicking back in, possibly consumption spending, maybe some stimulus on top. So you could see some very nice numbers off some terrible 22 numbers. But you got to remember that, China is not the growth engine of the world. Everyone thinks, second biggest economy in the world. It must be the one, contributing to global GDP. China is exporting to the world. China's consumption is extraordinarily low. So the idea that China is going to consume its way, spread demand out and bring the economy back if there's a global recession, that's not in the cards. But certainly a recovering China that's better than it has been in the last year will be a little bit of a positive signal.
Of course, Taiwan could be as big, if not bigger, question mark than COVID. Former Trump administration National Security Advisor H.R. McMaster shared his thoughts on what the U.S. can expect from China on Face the Nation Sunday. Listen.
I think we are underinvested in defense in the United States. China has become increasingly aggressive, not only from an economic and financial perspective and a wolf warrior diplomacy perspective, but physically. with its military. And what's really disturbing is I think Xi Jinping is preparing the Chinese people for war.
Preparing the Chinese people for war. Do you buy that? And what would the implications be for the economy?
Well, again, you have to always talk about timelines. Is he preparing it for war on a 10-year timeline, or are we talking about 2023? So obviously, I don't think he's preparing for China for war in 2023. That doesn't mean there is not an important case for focusing on this issue. There is a major issue that could end up a war footing between the United States and China over Taiwan if the United States doesn't take this seriously, and China, reads into the situation that they can move without a proper counter reaction. So this is a very important issue. But again, you have to talk about timelines. Are we talking about 1 year? Are we talking about 3 years? Are we talking about 10 years? You're gonna have a very different answer depending on what number you give me.
All right, Lula Miller, always great to have you on, CEO of China Beige Book. Thanks so much for taking the time, and Happy New Year. Well, coming up, Netflix getting a big boost from one Wall Street analyst. Find out what's driving that optimism next. Netflix shares popping last week, and this comes after a double upgrade from CFRA Research, the firm putting a buy rating on the stock and raised its price target to $3.10 a share. Joining us now to discuss is the analyst behind that note. We want to bring in Ken Leon, CFRA's Director of Equity Research. Ken, it's great to have you here. So let's talk about why you're more bullish on Netflix. Certainly 2022 was a tough year for not only Netflix, but really the industry at large. Why do you see that tide turning this year?
Well, thanks for having me. And 2023 and 24 are going to be, I think, great years for Netflix after a challenging 22. We had a sell rating for most of 22, and mostly we were too severe, I think, on our evaluation where we feel it was or felt it was no different than any of its peer group. But then we took another look at this company and we look at some of the new catalysts for 2023. And we say Netflix does deserve a premium. We're talking about a company where it has management in place for over 10 years. That's not true for Disney, Warner Brothers, or even Paramount. Secondly, the company's single focus on video streaming, and the secular shift is from linear networks to video streaming. Additionally, they have really invested in both programming content and technology platform that they're reaping the benefits not only in the US and Europe, but also in markets like South Korea, Turkey, et cetera. So where that leads you is a premium valuation. So we raised our target up to 310. We still think this company has lots of opportunity with new revenue sources. Widely noted as advertisers and marketers for the first time will be using Netflix platform. Second would be the new ad pay plan at $6.99 per month, more likely to bring in demographics more middle class, less affluent, and it won't cannibalize their current base, which goes as high as $19.99 per month for really a lot of features you can't get at the lower rate. And lastly, and this is kind of the unspoken truth, is so many of us and friends and family share our account, and that's going to be, I'll say, gracefully pulled back, or where you can be added for maybe $2 or $3 a month. So all that leakage is going to create revenue and cash flow for Netflix. So I like what I'm seeing. I also think, again, they continue to deliver great new episodes, great new features, and they're not spending billions of dollars on a market loss leader, which is sporting events, which has become so crazy to compete with to get any of those.
Yeah, it's interesting to see them stay out. Does look like a good decision when you consider $75 billion a year for the NBA. But it's that ad tier that was supposed to be the game changer. And the initial rollout didn't sound so good. Only 9% of new signups chose that tier, and Netflix had to return money to advertisers. Why does that not factor in, and where do you see that improving?
We see it improving in the second half of this year into 2024. When you look at the 47 analysts who cover this stock, they do have growth in both revenue, and this is part of it, in 23, but then up in 24, and a significant increase in EBITDA, which is an important measure for valuation. So again, what we haven't seen yet is not only this lower rate ad pay plan, but which is true, small out of the gate, but also the advertisers, both for spot and longer term contracts, which are going to get new business. And they're going to take that away from some of the broadcast networks in terms of advertising.
Ken, when it comes to live sports, a number of rivals, Netflix's rivals, have turned to that in order to drive some of that subscription growth. You make the case that you don't think that's necessary. I guess, why not? Is it purely just based on the amount that some of these rivals are paying for those rights?
It really is. It's such a high hurdle that to really have that kind of investment, the returns are just very challenging. But if you're live sports and live news like Fox, and we have a buy in FOXA, and they're staying out of streaming, they do that very well. Paramount's trying to do both. Disney with ESPN is trying to do sports and streaming. Disney's got a lot of challenges, but the stock has been so hit that we think Bob Iger's going to create some new catalysts to get the stock higher, which is why we have a buy in Disney. But again, for best in class, that premium to the peer group, and a management that executes and trusts each other for over 10 years, I think we're going to see good things from Netflix in 2023.
Ken, Netflix spent $450 million to acquire the Glass Onion franchise, if you will, the Knives Out franchise. Glass Onion, terrific movie. What is stickier for streamers right now? Is it movies like that, or is it the shows that they have really found success with, more like Emily in Paris? Is that worth the money?
They have both, so whereas if you go to Amazon Prime Video, a major competitor that spent billions, just related to getting the Lord of the Rings or in the case of HBO Max with, of course, House of Dragons, which was great, but it was over in what, 10 episodes? So Netflix is just prolific. They spend about $17 billion. It looks like you have to remember, again, this is an organically grown company that hasn't made acquisitions other than this one recently. And they've been able to generate an enormous library of their known franchises and episodes as well as movies. So more to come from Netflix, and they're actually more confident generally of their own creation versus spending over $1 billion and getting a flash, and then once it's over, you have higher churn. So a lot more to see here on these issues, but again, Netflix has confidence in how they do business. I don't believe Paramount, Warner Brothers Discovery, or Disney have video streaming figured out yet. And then there's a host of other players here that are here for either for one big spend, big event, whether it's Amazon or even perhaps YouTube getting Sunday NFL streaming. And they're all experimenting, but Netflix fully understands this business. That gives them an edge.
All right, CFRA Director of Equity Research, Ken Leon. Good to see you, sir. Thank you.
Thank you.
Okay, forget the New Year's resolutions. Shopify has a much better idea for its employees, a quote, calendar purge. That means effectively removing all recurring meetings with more than 2 people in perpetuity, and adding a new rule banning all meetings on Wednesdays. Shopify limiting meetings of more than 50 people to 1 per week, and also encouraging their workers to decline other meetings and cut back on internal chat groups. But why? Well, it's as simple as addition by subtraction. Their CEO and co-founder, Toby Lutke, he believes fewer meetings will make employees more productive. This, Shauna, is an approach I applaud as we enter the new year. I hope this one spreads.
He's hoping it spreads here to Yahoo Finance.
I
I'm reading
just said
between
spreads.
the lines
I didn't say come here.
Yeah, it's interesting. I think it makes a lot of sense when you take a look at how much time people are spending in meetings now compared to what they were pre-pandemic. And Microsoft was out with data saying that the amount of times that people have spent in meetings during the first 2 years of the pandemic, it was triple than what we were spending in meetings in 2019. So you got to start questioning how productive some of these meetings are. And it's not only Shopify that's taking a stance on this. We know Meta has been one of those companies, Clorox, Twilio, in the past that have instituted no meeting days. So they're trying to look, or I guess find some time for their employees to carve out time to themselves, not have to spend as much time in meetings. You're right, it hasn't come to Yahoo Finance yet, but I think it is a good idea. And I think we're going to see more and more companies start to do this. My question though is, how are you really going to be able to enforce this, right? If you work for someone, your manager is a big believer in the meetings, it's gonna be hard for you to say no.
That was my initial reaction. Okay, the person who handles my performance review, I now get to turn them down when they ask for a meeting. So therein lies a lot of questions as we move ahead. But I think the key for meetings is make them in person and make them productive, quick, concise, and get in and get out.
Yeah.
Nobody gets hurt.
I'm with
when they
you.
drag on,
Makes a lot of sense.
Yeah.
They should all listen
Toby
to us.
Lutke should come on Yahoo Finance and talk about it.
He should. We would love to have him. All right, well, coming up next year on Yahoo Finance, the Fed's interest rate decision impacting rates on everything from your mortgage to your credit card. We're going to tell you what to expect in those rates this year. Stay with us.
It's the start of a new year, but the same old rising interest rates will continue to be a hot topic for Americans. According to Bankrate.com's interest rate forecast for 2023, the hike may be more severe than expected. Bankrate sees rates climbing to 5.5% during the first half of 2023. That's higher than the Fed's current forecast. Joining us now for more is Greg McBride, Bankrate.com's chief financial analyst. Good to see you, sir. So how do we break that down? Are we talking about a 50 and a 25 and a pause, or how do you see it? And why do you think the Fed has to bring rates up to 5.5?
The economy has certainly been more resilient than I think a lot of people expected, considering we have 7 rate hikes in the rearview mirror. And so I think that's going to give the Fed a little bit of leeway or compel them to continue to raise rates in the first half of this year. And how that breaks down, I think they've got certainly some options. And I think that's going to depend on what we see on the economic data, particularly employment and inflation. But whether they raise rates at another 0.5 percentage point and then go quarter point increments, skipping a meeting along the way, or if they go quarter point all along the way, a lot of that's going to be dictated by the data. But I've got them raising interest rates another full percentage point, but doing so in the first half of the year and then moving to the sidelines. What I don't have in the forecast is them reversing course and starting to cut rates in 2023. Once they're done, I see them plateauing and holding steady for a while.
So, Greg, all this will add up possibly to more pain for the economy, more pain for consumers. So let's talk about what it means from a consumer angle. Starting with credit cards here, rates reaching record highs we saw in 2022. When you take into account a hawkish Fed, what does that mean for credit card holders in the new year?
This is one where if the Fed is going to raise rates another 100 basis points, 1 full percentage point, your credit card rate's going to go up 1 full percentage point. So this is really important. If you're carrying a balance, now's the time to take some action. Grab one of those low rate balance transfer offers, turbocharge your debt repayment efforts, because the most expensive debt you have is going to continue to get more expensive, and it's going to move in lockstep with whatever the Fed is doing.
And what about auto rates? What does the Fed action have to do with auto rates? How will it change it? And how will that impact the sector as a whole?
I do see some more upward influence on rates here. I mean, there's not a 1-for-1 correlation with the Fed. I think on average, I've got new car rates will be up about 0.75 percentage point this year. Used car rates up closer to a full percentage point on average. The key thing for borrowers here, make sure your credit is in good shape and shop around. We do see a wide variety of terms, and your credit rating is going to become even more important, and particularly if we start to see the economy weaken. That's going to be the difference between paying 7% or paying a rate that could be double that. As for the impact that's going to have on the sector, it doesn't help, but it's not the headwind I think that a lot of people think it might be, in the sense that, like what we've seen in housing. Auto loan rates, another percentage point of rate hikes, makes a difference of about $25 a month on the payment, but it's $25 on what's already an $800 payment. So is that really going to, is anybody going to downsize from the SUV to the compact based on rising rates? Probably not.
Greg, you mentioned housing, so let's talk about it, because mortgage rates was a huge story, especially in the second half of 2022 when we saw those rates rise above 7%. Where do you think rates are headed this year?
I think the first half of the year is going to be pretty choppy. We're in the high 6s right now, so I think between 6.5 and 7 here in the first half of the year, at least until the Fed moves to the sidelines. Once we get to the second half of the year, if the Fed's on the sidelines and we're starting to see more evidence of that economic slowdown or the recession that 2 out of 3 economists is forecasting, that's when we'll see a more sustained slide in mortgage rates. But it's, temper your expectations. I mortgage rates fall into the low 5s by the end of the year, 30-year fixed at 5.25%. Now that's a big improvement over where we are now, but that would still leave rates 2 percentage points higher than they were this time a year ago.
Right, and do you expect them to stay at that level around 5.25 into 24? And is that enough to stimulate the housing market, or will it stay frozen?
I think a lot of that's really going to depend more on the health of the economy than it will on the level of mortgage rates. Some of the lowest mortgage rates we've ever seen historically have been in periods where the economy was on the ropes and the housing market was comatose. So when the economy's bad and people are worried about their job, they don't buy houses. So if we have economic weakness or a recession that's really driving those lower rates, I don't think the low rates are going to pull a lot of people off the sidelines. I think when you get some stabilization in the economy and there's a feeling that things are on the rebound, that's when people will come off the sidelines and look to buy, even if rates have ticked up a bit at that point.
Bankrate.com's Greg McBride. Good to see you, man. Thank you.
Thank you.
Okay, my stock to watch for tomorrow is GE Healthcare. The company is set to start its first day of trading tomorrow at market open under the ticker GEHC. This is the first step in the splitting up of General Electric into 3 separate businesses. GE's healthcare unit makes about $18 billion in annual revenue from MRI imaging, ultrasounds, and pharmaceutical diagnostics, and currently has a valuation of $31 billion. GE stock ended 22 down almost 12%. Coming up, exercising more is one of the most popular New Year's resolutions, but one gym didn't want your New Year's Day signups. Stay with us to find out who and why.
Losing weight is one of the more popular New Year's resolutions, but Equinox didn't want your New Year's Day sign up. You heard that right. The company launching a new campaign with the slogan, quote, "We don't speak January." Now, as part of that campaign, they didn't let new members join on the 1st of January. In a tweet that you're looking at right now, the company listing reasons why it doesn't speak January. Now, among this, January is, quote, "a fantasy delivered to your door in a pastel-colored box. It wants you to start something when you should already be in the middle of it, and it needs a new outfit before it can begin." It goes on to end Dave stalling, shortcutting, giving up. I'm on Equinox's website right now, and it still states at the very top, January promises and doesn't deliver. We don't speak January. An interesting marketing concept. Maybe it pays off. Bizarre, but I like it.
A lot of people hated it.
Yeah.
And on social media, we're very, very critical of it. Unfortunately, we tend to agree on this as we do a lot of things. Look, Equinox members are not your everyday average fitness members. They're not Planet Fitness members. They are hardcore, I would describe them, and I don't think they'd be offended by that. So therefore, I think this really works for their core market, the type of people that join Equinox. And believe me, it was just one day where they wouldn't allow new signups. They weren't really turning you away, but it does speak to We don't want the amateurs, we don't want the rookies, we don't want the New Year's resolution crowd here that packs this gym in January and then goes away. 52% of Americans choose exercise more as their New Year's resolution. 40% say they want to lose weight. That's not who they want. That's not my type of New Year's resolution. Is that ever yours?
Well, you know, I have to be honest. This year, since I do have 2 young kids, one of my New Year's resolutions was I wanted to be more, I guess, I work out, but it's not always with consistency, right, in terms of the number of days of the week. So it's not like I'm totally changing. I just want to be a little bit more consistent.
We're going to talk to the Equinox president about this tomorrow.
I think it makes sense. I wouldn't just join for a day and quit. Leave it there.
Good. All right. That'll do it for us for Yahoo Finance Live today. Be sure to join us tomorrow at 3 p.m. Eastern. All your coverage leading up to and after the closing bell. Happy New Year.